going to unpack the main messages sent at China's annual Central Economic Work Conference. And for our international audience who may not be too aware of what this conference is about, this conference is held in December of every year. And during the meeting, top policymakers decide on the priorities for economic work in the following year. So if we look back at 2022, China has kept inflation in check, food and energy security were safeguarded, employment was stabilized, and supply chains remained quite resilient here in China. And all this, of course, despite the challenges from COVID-19 and some of the external pressures we saw in the global economy as the global economy faced a slowdown. And we also, of course, have rising recession risks in many of the major advanced economies. So as we gear up for 2023, many, I think, will be looking to see just how strong the recovery momentum will be in the world's second largest economy. And definitely the Central Economic Work Conference will provide us with some more clues on that front. So what are the signals sent from the work conference and what are the economic priorities for 2023? Let's discuss all of that and bring in our panelists to today. We have Mr. Ding Shuang, who is the Chief Economist of Greater China and North Asia at Standard Chartered. We also have Dr. Wang Huiyao, who is the president at the think tank Center for China and Globalization. Dr. Wang was also a former counselor at China State Council. And we also have Chen Jiahe, Chief Investment Officer at Novem Arcae Technologies. So welcome to all of you. Dr. Wang, I want to begin with you in terms of just setting the overall tone for us in terms of what were your main takeaways from the Central Economic Work Conference that was held here in Beijing. I think ensuring economic stability, that is definitely the tone set by the central government. So in terms of economic work for next year, that's going to be the framework in which the work will operate under. But do you feel there is a pro-growth bias and a tone that was sent from this year's work conference?
Yes, thank Michael, and also thank all the other panelists. I think this is really a great marching order, probably is long overdue, because as you know, this Central Economic Work Conference was held at this turning point of China. COVID situation is now really starting to under control, and of course starting to open as well. And I think it is exactly ushering a new era for the next year, particularly after 3 years of almost lockdown and no exchanges probably extensively with the world in terms of the people-to-people exchanges, and also of course the impact of it's on the domestic economy and international has been very seriously felt. For example, the GDP growth this year was probably going to have around 3%. So what I think now, we need such a strong confidence boost, because I think this Central Economic Work Conference has sent several very positive signals. First, it emphasized the growth and that going to be geared up for the next year. Second, I think there's quite a few re-emphasized, which I think is very important. Re-emphasize the private sector, the private enterprises. We have to attach great importance to them. Re-emphasize the domestic market. We need more revival of the domestic market, such as real estate, probably. Also the talent. We have to emphasize. We need to import more talent, and also emphasize foreign enterprises. We have to really create all the conditions for attracting them back, and also facilitate their visit. Do their very best. And of course, finally, they talk about the Chinese big companies in the private sectors. They have to facilitate all those platform companies to go global and to be more competitive. So I think there's many things. Of course, they were also talking about revive the consumptions of domestic economy, and that's very much important, because of the the next year we're going to see if the economy going to hit another 6-7%. We have to really revive. We have to use all the tools we have. I think China economy has suffered quite a bit in recent years, and this is a great turning point. The Central Economic Work Conference is really also the new leadership. I mean, the new standing committee members all presented there, and I think they give a lot of emphasis on the business front, and this is really a good signal to be interpreted.
I also think there was definitely a strong emphasis on consumption for next year. So speaking of growth and how much consumption could be driving growth next year, Mr. Ding, I want to come to you. Correct me if I'm wrong, but I believe Standard Chartered calls for 5.8% economic growth for China next year, which is above market consensus right now. Out of that, how much do you think consumption will contribute to that growth? Because from the readout of the Central Economic Work Conference, the first thing that was mentioned in the to-do list was to prioritize and expand domestic consumption.
Yes, indeed. Consumption underwhelmed in 2022. And I agree with Dr. Wang that the growth in 2022 could end up only about 3%. And this is mainly due to the very stringent COVID control measures and to a lesser extent to the ongoing property market correction. So the 3% GDP growth this year, perhaps only 1 percentage point contribution from consumption. So compared with the pre-pandemic era of average about 3 to 4 percentage point contribution from consumption. But the recent shift in policy, the relaxation of COVID control measures, that paved the way for a normalization of consumption next year. Don't get me wrong, I think the recent surge of the COVID infections could deal a blow to near-term consumption and economic activity. But if we look at experience of other countries, in a few months, possibly at the end of the first quarter, we may see the consumption start to get back to the normal level. Our base assumption, assuming there will be a pent-up demand, improving employment outlook, and also based on elevated household savings, we assume that the household consumption will get back to the pre-pandemic trend level in the second half of the year. And that is equivalent to about 4 to 4.5 percentage points contribution from consumption. So that underpins our above consensus GDP growth forecast for next year of 5.8%.
And Jiahe, so the CEWC, the work conference, talks about boosting the ability to consume. It talks about improving the conditions to consume and creating new opportunities and ways to consume as well. So based on that statement and tone, can we expect more pro-consumption policies in 2023?
Yeah, definitely. I mean, the government is really keen on improving the consumption right now because, when we look at the past 3 years, the investment has been taking a very important job for the economic growth. The export has been strong, but the consumption has been depressed somehow because of the anti-COVID measures has been taken. So it's quite many policies that the government can and will use in the coming year. I believe there will be many, many ways to look at that. They can give consumers coupons, they can give subsidies to consumption components, stimulating tourism industry, even expand some of the holidays, who knows?
Mr. Ding, you mentioned pent-up demand and consumption as a driver for growth next year, but some analysts question just how strong that pent-up demand may potentially be, even for the second half of next year, because if we take a look at wage growth, it's been a bit anemic relative to pre-pandemic years, and there is still that negative wealth effect from a still recovering property sector. So given all of that, I mean, how strong do you think that consumption rebound really will be, or do you think consumers will remain still a little bit more cautious for a little bit longer?
Yeah, first, I'd like to clarify, we are talking about a normalization of consumption instead of what some people may call the revenge consumption. So I think it's more about getting back to a normal life. If we look at the current consumption level, especially in the service area, it's way below the pre-pandemic level. If we look at the box office, the catering in restaurant, the air travel, railway travel, so getting back to the pre-pandemic level, that would already suggest a very big potential for the rebound in the second half. So let's actually, it's quite difficult to predict the consumer's behavior, but we can actually turn to history, the recent history for some guidance. That is 2021. After the first shock, COVID shock of 2020, we see the consumption rebounded very quickly. In 2021, consumption grows more than 9%. contributing 5.3 percentage point to the 8.1% GDP growth. So we are actually talking about a normalization, and that I think with the improving job opportunities and income, that would be, I think, provide a lot of boost to the consumption. And also, I think we are talking about consumption at an aggregate level, at a national level. We tend to lose sight of those households still struggling to keep their jobs, to pay their mortgages. So it is in this area, I think the fiscal policy, targeted fiscal transfer can go a long way to stabilize the consumption, because these households tend to have the highest propensity to consume.
So, Mr. Ding, let me follow up on that real quick, because in the readout of the work conference, fiscal policy will remain prudent, will remain proactive for next year. Monetary policy will remain prudent. Fiscal policy will remain targeted and more effective. Are there any other nuances that you saw perhaps from the readout of the work conference that may suggest further implications for growth next year?
I would say the Central Economic Conference called for a strengthening of the macro policy adjustment. My interpretation is macro policy will still be quite supportive and accommodative. On the fiscal side, as you already mentioned, I think the government is likely to, they want the fiscal policy to be stronger and more effective. And in particular, they talked about to maintain the intensity of the fiscal spending, but in the meantime, to safeguard the fiscal sustainability and keep the local government debt risk under control. So my interpretation of that is, first, I do not expect a super stimulus, I think, for 2023, but the official deficit ratio, last year it was 2.8% of GDP. It could be increased slightly to show, I think, a more proactive fiscal policy. And also, the focus will be more on the spending side. Unlike last year, it's more about tax cut. And we may see more transfer from the central government to the local government to increase the local government spending capacity without increasing their fiscal stress.
So, Mr. Ding, when China continues to optimize its COVID-19 policies, and we do see that consumption rebound for next year, how reflationary do you think that might be? Because inflation was kept quite in control during these pandemic years. But once China further optimizes its COVID policy and we see that reopening, what is that going to mean for inflation here?
If we look at other countries, reopening usually is followed by high inflation. I think that could be more or less the case for China as well, but the degree of the inflation rebound could be much less compared with the US or Europe, for example, where the inflation rate rise to close to about 10%. I think the special situation here is when China reopens, when China's economy will recover, the rest of the world start to decelerate and slow down. So if we look at a breakdown of the CPI inflation, for example, the fuel price could drop actually instead of rising because of weak global demand. And China may still experience some food inflation from the pork, but for the within the core inflation, which exclude food and fuel, the goods inflation is likely to be quite moderate because China is, I think, the biggest manufacturer in the world, have excess capacity. So I do not expect a lot of inflation for goods, but inflation, that's actually the main source of inflation, in my view, after the reopening. As I mentioned earlier, I think China's the consumption of service is way below the level of the pre-pandemic level. And when there is a normalization, just like what happened in the US and Europe, the service inflation could rise quite quickly. But putting all those factors together, we forecast average CPI inflation of 2.3% for 2023, only slightly higher than our estimated 2% this year. In other words, the inflation or reflationary pressure will not prompt the PBOC, the central bank, to hike interest rate.
Got it. Dr. Wang, I'm going to come to you now, because for consumption to rebound, I think consumers, households, companies, market entities in general need to have that confidence to spend and need to have that confidence for the future as well. And in the readout of the work conference, it was stressed quite early that China will strongly, the word strongly was used, to strongly work to boost market confidence in 2023. How do you see policymakers really strongly boosting market confidence for next year?
Well, I think that China is a country that if the policies are correct, that can really unleash enormous power. So I think the biggest thing is the confidence. I mean, now that the central government is really determined to revive the economy and put out a lot of measures, a lot of new confidence boost plans. So what I think is there's quite a few things can be done. For example, Jane mentioned about these coupons. That I remember the first round in 2021, Beijing municipal government issued a lot of coupons that stimulate a lot of shopping centers to really open. And also I think that could be also very importantly that the tourism. I remember 2021 during the Golden Weeks, there's a flood of tourists around the different parts of the country, and that really caused enormous consumptions throughout the country. So that kind of unleash of the consumption is very, very important in China. And of course, again, we yet to see international travel. I think the international travel is before the pandemic, there's over 150 million outbound tourists. I think there could be retaliatory outbound tourism because all the other countries are open, and now China has been. If everybody have gone through this Omicron once, or most of them gone through, they will be not afraid anymore to go travel. So that will again also boost confidence across China. So I think very important, and also the school. I think there's school has to be started, and then all the school shopping. Back to school shopping, and there all will be something. And also there's coming up of a New Year and a Chinese New Year. That is not a big season for traveling and the consumption. Over 1 billion or 2 billion people will travel throughout this holiday season. So all those things I think will add it up, and I really expect that things be improved by the early next spring. And so this is once China is really giving a right policy. The turnaround can be very quickly, so I'm quite optimistic on that.
Yeah, I mean, anecdotally, I already have friends that have pre-booked plane tickets to, for example, South Korea and to Thailand as well. And I'm ready. I mean, Dr. Wang, I'm not sure about you guys. I'm ready to take a high-speed train just on a weekend, pick up a backpack and just travel around the country because the infrastructure, the transportation infrastructure is just so convenient to travel around here in China. But in terms of other elements to support consumption down the road, especially long-term, there was one saying that I found interesting in the work conference, Mr. Ding. I want to come to you now, because the readout said expanding domestic demand must be combined with China's supply-side structural reforms. So help our international audience understand what China means by that in terms of how supply-side reforms can actually lead to a boost in consumption down the road.
The purpose of the supply-side structural reform is to improve productivity by optimizing the allocation of resources, including human resource, capital, land, and technology, and so that I think high quality and more supplies can be offered to the consumers, or actually high quality goods actually could create demand for high quality consumption goods. But to achieve that, I think it is essential, first is to allow the market force to play a more decisive role in the allocation of resources. And secondly, to give full play to the initiatives of the individual and the enterprises. So it is in this context, I found two remarks in the Central Economic Work Conference quite striking and encouraging. One is about the internet platform. The country will continue to develop a digital economy to normalize the regulation. to encourage internet platforms to compete internationally while creating more jobs. The secondary is about, I think, the reiteration about the role of the private sector to unwaveringly support the private sector to treat the SOE and the private enterprises equally to encourage their expansion. So those are a very important message in my view. And that is, in my view, that is essential part of the supply side reform that could help to boost confidence, not only in 2023, but in the longer term.
Yeah, I want to get back to the private sector, the comments made about the private economy and the platform economy in just a second. But Jiahe, I want to quickly come to you in terms of supply side reforms that we're going to see in this country. What does that mean for international supply chains? Because the base of Chinese consumers is so huge. There are 400 million people in the middle class right here. So what does supply side structural reforms mean for international supply chains, especially though in an era of protectionism and unilateralism?
Well, some people may worry that because China relies heavily on domestic supplies, and that will pose a challenge to the global supply. I personally don't think so, because currently China is building very strongly on things like high technology, stuff like that. So China will be a very important supplement into the global supply chain. The more China gets into the global supply chain, the more possible that the global economy will move with a higher speed to grow. One other thing is that if China does not stimulate our own supply chain economy, there might be more conflict between China and the US economy when we talk about trade and things like that. Because in that case, there would be more bargaining power held by the US economy to say that we're blocking this from trading to you, we're blocking that. So that would, well, this is a very tricky thing, but if China does not rely on the domestic supply chain, that will possibly mean more trade conflict between China and the US, because the bargaining power will be leaning toward the US economy. So with a stronger Chinese economy, it is more possible that we see the global economy, the global economy will be more smoothly developed, because China is taking like 1/5 of the global population. And if we have a strong economy over here, that's a good thing for everyone, I would say.
Yeah, and I think as China further continues to develop its own supply chains, that should mean smoother trade links in the region as well, especially with RCEP really coming into force and coming into play as well. Dr. Wang, I want to come to you and talk about the platform economy that Mr. Ding mentioned. So the readout said that policymakers will support platform companies to play an important role in leading the country's development and in creating jobs. And of course, this comment was not made in 2021's Central Economic Work Conference. Give us your perspectives on that in terms of why do you think policymakers mentioned that aspect of the economy?
Well, I think that message actually is very important. As you know, that all those big companies, BAT or JD and all have employs tens of thousands or hundreds of thousands of people in China in the high tech sector. And you see in the last several years, the digital economy in China has explosive growth. Now it become the second largest digital market in the world. Accounts about over 40% of the GDP now. And actually, those companies are really vital to lead the internet revolution and digital transformation in China. You have seen a live streaming in different parts of the rural area even. That is really all driven by these platform companies. So I think the new leadership now, I think, realized the importance. I think you see, the new standing committee member, 4 of them are actually promoted from a very developed area in China, from Shanghai, Zhejiang, and Guangdong and Beijing, actually. And then you see actually that they are. I noticed that Li Qiang, the second ranking Politburo member, actually went to the 5 years meeting of the China Federation of Industry and Commerce. He gave a speech there, and he gave a lot of importance. So he's familiar with those private sector, and particularly the digital economy. So I think that the sentiment, there was quite a bit overreading into that China was trying to curb the big enterprise, particularly digital economy development. Those private sector are really also backbones of the domestic consumption, and probably the new form of consumption. We see how digital actually helped during the those COVID cases, I think with the online buying, online delivering, that's really carried the consumer overcome so much quarantines and those hard times. So I think now that message is enormous, as probably Mr. Ding mentioned about it. It's really enormous in terms of encouraging the private sector. I think private sector accounts about 60% of China's GDP now, and over half of the 50% of federal government tax on that, and local government tax on that. So I think this boost of stimulate the private sector is so crucial, because they were really the most hard hit during this pandemic. And I think this Central Work Conference gave a strong confidence to those private sector. I think that is really will really pave the way for more liberalization of those IPOs, of going overseas, of local banks could support them more with loans, and then we will see rather than they are firing people, we will see those big companies starting to hire as time goes on, next year sometime.
Yeah, and of course, online sales of goods, online retail sales, the growth of that always outpaces total retail sales by quite a significant margin, I would say. And speaking of the private economy, Mr. Ding mentioned this, in terms of the support for the private economy, for private businesses, that was indeed re-emphasized at the Central Economic Work Conference this year, because I feel like there's been some misperceptions abroad that China's public sector is dominating the non-public sector and maybe at the expense of the non-public sector. But that can't be further away from the truth, because the policy here in China has been consistent and it has been unwavering, like Mr. Ding said, in terms of China's support for the private economy and for private businesses. And this support was mentioned in the to-do list for economic work for next year. So Dr. Wang, why do you think policymakers needed to re-emphasize that at this year's work conference?
Well, I think this is also explained by the, further by the 20th Party Congress report. In that Congress report, they talk about two key part of that. One is the Chinese path of modernization. I interpret Chinese path of modernization. Chinese economy is really hybrid. I mean, China has experimented with great success with this hybrid economy, like 60% of private sector, and that generates 60% of GDP. And you have another 20% SOE that does all the stability, public goods, and social responsibility. Like fighting COVID. 40 medical staff were parachuted into Wuhan. That's all SOEs. So disaster relief or earthquake help and things like that. And then you have another 10-50% of multinationals, which employs 40 million workforce in China. Just Foxconn alone employs 2 million. And then they support about 50% of China's import-export. So this hybrid economy is really the Chinese style of modernization that no country actually have that. So I think that has been emphasized at 20 Parties Congress, gives more boost of central economic workforce to follow on that. And again, the second point is the common prosperity. The common prosperity means that we lifted not only 800 million people out of poverty. How about the 300 million migrant workers? We have to make them into middle class too. And then we have created the 400 million middle class. What about the 1 billion still there, and 600 billion making less than 2,000 months? So I think there's a lot of new points and new guidelines out of this party Congress. This Central Work Economic Conference is implement that and is strengthening that and emphasize that. So I think these private sectors and also lift a big consumption of the middle class are the 2 points that this Central Economic Work Conference really followed closely and really implement for the next year.
In terms of other work priorities for next year, Jiahe, I want to come to you, because another point on the to-do list for economic work next year, the work conference talks about forestalling and diffusing major economic and financial sector risks. So given China's property sector is still in recovery mode, and if we are perhaps expecting stronger credit growth for China's economy next year, given that we are expecting faster growth next year, give us a sense of the state of play for financial stability here in China. How strong are China's banks? How well capitalized are they? How much money have they set aside perhaps to deal with maybe more sour loans down the road? I mean, how strong is China's banking sector to weather any adverse shocks to the financial system?
Well, I think I got quite many information for you because we've been investing in both Asia and Hong Kong. We have about 20% of banks in our portfolio, which totally we take 99% in equity. So we really favor banks when we look at, and we read through all the financial reports of these banks. It's very easy to tell by reading the financial reports of these banks that China's banking system is now at probably its most healthy status for the past 15 years. I mean, that is expressed in two ways. First is the NPL ratio, the non-performing loan ratio, is now at one of the lowest points in history. It's usually about 1.5% or 1.3% for a large bank. So that's a very, very low level, you know. When you think that back 22 years ago in 2000, the NPL ratio for banks were about 20 to 25%. So now you can see we only have like 1.2%, 1.5%. It's really low risk. The second is that Chinese banks are having a very low leverage. I mean, if you look at what happened back in 2008, the global financial crisis, the global banking system, especially the US banking system, failed, and the securities companies failed because they had being over leveraged. You know, the leverage for a Euro bank at that time would be like 20 or 30 times, and some of the security brokers got like 200 times leverage. That means a very small loss on the asset that they hold would mean a huge amount of destruction to the book value, and which lead to the bankruptcy of many companies. But if you check out the leverage of Chinese banks right now, I think it's about like 12 or 13 times, which is the ratio between the total asset and the book value. It's about 12 to 13 times for most of the China's large banks. And if you check out the data back in 2015, that was about 15 to 17 times. So the overall leverage has been dropped by almost like 30%. So that means these companies are not over leveraging at all compared with their own history, compared with what happened back in 2008. So they're not over leveraged. So you would be able to say that Chinese banks are really healthy right now. The only thing that people are worrying is that the property price in metropolises in China are just, well, too expensive. The rental yield is around 1.5%. So that's really low because usually you want the rental yield to be around 4%, but we only have like 1.5%, and the rents are stopping to grow back in the, well, past year. So that's a small problem, but I would say that problem is not large because China's banks are not over leveraged on these assets. So I would say, overall speaking, when you look at the banking system, it's pretty healthy.
Okay, so Chinese banks overall right now, lower leverage compared to historical norms, historical standards, and also well provisioned as well to deal with bad loans. So commercial banks are okay in terms of dealing with adverse shocks. On the policymaker front, when you look at financial regulators, they have enough policy tools to deal also with any potential financial shocks and tools in the policy toolkit, you think?
Well, one good thing for the Chinese, the whole Chinese financial system is that we are more like a, well, we're more like a whole system rather than different companies betting against each other. You know, if you look at the global financial crisis, every time a financial crisis chain has been triggered, it's because one company is failed and it brought like a domino card, then another company is failing, all these companies started to fail, and finally the government body step in to say, okay, you can't do this. But that's probably 3 or 4 months later, and you have like 10 banks broke up already. So that's what's going on in Euro case. But in China, is that the government authority are usually having stronger motive and the authority and the capability and financial tools to stop a financial crisis once it started. So it's a very interesting thing that in the past, like 5 years ago, when you see some security brokers are doing something wrong or some banks are doing something wrong, their bonds issued are still very flat. Okay, their stock prices might be dropping because people think their earnings will miss the target. But when you look at the bond price, it's really flat, which means the financial market is much less to get panicked in China compared with the global market. So when you talk about the authorities, I would say they're much stronger in China compared with the Euro financial authorities in the world.
Mm. So let's talk about the property sector then, because Chinese banks do have significant exposure to China's property sector. And at the World Conference, it was said that China will promote the steady development of the property market. to ensure timely deliveries of pre-sold housing and to meet the reasonable financing demands of the sector. Mr. Ding, I want to come to you because recently we saw a raft of measures to support the real estate market, both on the demand side and on the supply side as well. Are you expecting more policies to support the property market in 2023?
The housing sector experienced a major downturn this year. So take property investment, for example, it dropped by 9.8% year on year in the first 11 months. If we look at other indicators, even worse, deeper contraction for sales, for new starts, for the land acquisition by the developers, or 30, 40, or 50% contraction. And also because of the failure by some of developers to deliver home and failure of developer to pay their debt, that fueled the concerns about meltdown of the market. But the government started to step in to start to fine-tune the property policy in 2021 already, amid increasing sign of market correction. But if we look at those measures, mostly piecemeal, ad hoc, try to address the burning issue at hand without looking at the big picture. But this November, I think 16 measures were introduced by the financial regulators. I see that as a major shift from a piecemeal approach to a more comprehensive and systematic approach to address the root cause of the problems. So these measures address not only, I think, the financing need at different stage, including the developer loan, construction loan, mortgage, trust loan, acquisition loans, and also cover different forms of financing like loans, bond, and equity financing. So that is something quite major happening. And we also see quite a few follow-up measures since then. And I would say the frequency of the measure being introduced tell us the sense of urgency on the part of the government. And more recently, I think a few senior leaders, including Vice Premier Liu He, start to talk about the property sector as the pillar of the economy. So my sense is if the situation does not turn around, there could be more actions taken. The purpose, I think the first step is to put a floor to the sector. So I think the government will not take a wait and see approach, but rather very proactive approach to achieve a turnaround, to stabilize the market. And if these measures are implemented effectively, I think we may see a restoration of normal financing for the healthy, high-quality developers in the market. And also, we may see a consolidation of the market with the acquisition loan. We may see some developers going out of business, but those who survive would be stronger. But if we also look at the longer term, I do not think the government wants the property sector to again become a driver, an engine of the economic growth. It's more about give the sector its fair share of financing to stabilize the market, to meet the normal, reasonable demand of the population. Because going forward, China's priority is to allocate more resources to innovation, to high-end manufacturing, instead of infrastructure and the property sector, which also tends to be quite energy and carbon intensive.
And I like that you mentioned that the recent raft of policies, they are indeed comprehensive because it seems like they've covered all the bases, right? You've got home buyers covered, you've got property developers, construction companies, at the project level, at the company level. So it is quite a comprehensive package indeed. Mr. Ding, what do you think then is the pathway for the housing sector to recover for next year? Are policymakers going to have a wait and see attitude to see how these policies actually turn out? Are they going to introduce more policies like I mentioned just now? Or do you think we might need to see maybe another year before the housing sector really starts to bounce back?
The property sector actually suffered from what I call a negative feedback loop of weakening confidence and falling sales. So it's it's not easy to break that vicious circle. It takes time, but I think the government is likely to introduce more policy actions if there is no turnaround in the market. So if we look at, I think, the past experience, improvement of financing will have, I think, with some time lag, it will gradually start to improve the sales. So based on that, our assumption is that this process may take time, about half a year. We may see a stabilization of the sales and the investment, the property investment in the second half. So in other words, we do not expect a major rebound of the property sector, but the property sector is likely to be less of a drag for economic growth in 2023.
Okay. And also from the work conference, the readout said, of course, that China will stick to the principle that housing is for living in and not for speculation. Again, this has been a consistent policy for China throughout the years, but that also the country is seeking to promote a smooth transition for the real estate industry to new development models. Dr. Wang, what do you think China means when it talks about new development models in the property sector?
Well, I think this is really absolutely a very important issue. We know that the real estate sector has actually one of the key driving sector for China's high growth for the last several decades, particularly since housing reform started by Premier Zhu in the early 90s. You know, that I think that boom has really led you know, one of the biggest growth that we ever seen in this real estate market. And then you see China, you know, the urban center, the skyline has really changed because of this heavy investment. But I think somehow China has come to a point they have to make a right decision and a balanced development on that. For example, in the past, there's so much speculations, there's so much you know, overspending on that. And also all the local government municipality really relies on the land sale for its revenues to you know, basically for the public spending. So that kind of model, I think somehow needs to be reformed. So now, well, in the past, government has a lot of stop measure kind of you know, actions like they restrict the people to buy houses. For example, in Beijing, Shanghai, or the urban center, you know, one household can only buy one, for example. I think that kind of a, you know, short-term measure should be maybe gradually abolished, and then we should really let that open. So that would be another boost for the market. Another thing I'm thinking, you know, that this you know, that long-term reform is probably the housing taxes. You know, that all the local government in the past, they rely heavily on the land scale. But we look at all the world, all the developed world, the local municipality basically relies heavily on the housing, you know, property tax in order for the local government spending. So I think that probably will come in at some point of time, but not with a big scale, maybe at a very preliminary scale, gradually build up, so we can reach equilibrium of not hurting the market very much, but at the same time, changing the sole relies on the land sale of the local government to a more diversified source of income. So we can have a balanced growth, and then really let the property market play its rightful roles in its economy develop. So I think that kind of adjustment has to come. But I see now, the short term is that government going to make sure that all those money will guarantee that, for the apartment already sold, property already sold, that so that you don't have an unrest or the outcry of the consumer who already bought, but then without having its property. But also at the same time, they're going to open the restrictions. I noticed there's a number of cities already canceled the regulation that you can only buy one, or only local citizens can buy the property. But also given the every year is 10 million college graduates, given the urbanization going on, there's another every year 10, 15, 20 million people come to cities, that kind of rate. I think the demand is still there. It's just how we can really use that demand with the right policy, with the right different element of the tax plans, but also more investment, more credit, so that we can reach a really a very balanced, optimal policy development for the future. So that's really the key. I think that's really means that you have to innovate and put more emphasis on the policies.
Dr. Wang, I want to follow up real quick on that. So when it comes to new development models, what is the potential you think when it comes to long-term rental markets? I mean, the World Conference spoke about that as well, and policymakers have talked about this throughout the years. But the mindset, I think, for the Chinese consumer is that you have to own your own home. There's no right or wrong in terms of mindset, but it might be different compared to other economies where renting is absolutely fine. So what do you think in terms of, can China actually build up its rental market as well, like a long-term rental market that can help new graduates, new urbanites find a place to live and an affordable place to live at that as well?
Well, absolutely. I think it can. And we already have a lot of actually empty apartments in China. I mean, there were numbers saying that empty apartment can house another 100 million people. I don't know if that is true or not, but that shows you, if you go to many parts of the of China in the city, you see all empty lights of all the buildings in evenings. So that's really the problem. I think there's a lot of role that government played to digest, kind of a property sharing, condominium or rental market. Absolutely, there's talent flats being built in Beijing, Shanghai, and and I know some local government in Highland. They have 1 million talents to attract the Highland. They have to build a local flats for that. So the government certainly can be a major player. We already have the experience of Hong Kong, particularly the experience of Singapore. How these common property rental market for the average citizen. So I think that is really the key. And so it's really, I think, a combination of government rental property encouraging private developer to do that, but also municipalities has to be more supportive of the real estate economy and really have a bit better position for the developers, consumers, the government, local government, and just open for foreign investment as well. So there's many tools in the box that they can really employ. But I definitely think one is the government can support this rental market, and some by themselves, some by going for the developers to do it. So that is absolutely needed to address this swelling urbanization and also flooding of the migrants of the different parts of China.
Okay. So we touched upon consumption, we've touched upon the property sector. I want to turn the attention now to investment and the manufacturing sector. Jiahe, I want to come to you because the meeting also called for speeding up the construction of a modern industrial system for next year. And there were a few industries that were mentioned: new energy, for example, artificial intelligence, biomanufacturing, green and low carbon, quantum computing were all singled out. So besides a consumption boost, Jiahe, can we also expect an investment boost for next year as well, especially when it comes to high-tech manufacturing?
That's definitely the sign, because when you think about the scale of the Chinese economy, we got 1.4 billion population, and now with the second largest of the world, we can't keep on developing and be a country with a per capita GDP of 20 or even 30,000 US dollar without the development of our own high technology. So high technology, things like these, also the green energy, stuff like that, has been really important for the growth of the Chinese economy. In the past 3 years, it's been a bit hard to introduce the private capital, especially the private capital, into this part. Because when you look at high technology, usually private capital are more efficient in this part compared with the public capital, because that really needs a lot of talent to come in. And private capital would be more efficient with rewarding these talents, giving them millions or even tens or hundreds of millions of yuan to reward them. So the private capital are more efficient with developing high technology, but the public capital would be more efficient with developing things like infrastructure, airports, building, canals, things like that. But if you look at the past 3 years, the investment from private capital into high technology has been a bit slowed with this growth rate, mostly because the COVID and the COVID blockade measures have brought uncertainty for private capitals. They just don't know that how well will the new technology comes out. That's one uncertain point. And second is that many capital don't know that how much and how long can their capital last to sustain such a kind of investment, which usually takes a very very long period of time, like 2 or 3 or even 5 years before you see the reward. So the investment has been delayed somehow back if you look at the past 3 COVID years, what I call it. But looking into 2023, when you see the economy is recovering, people are having more confidence about the future, more confidence about the bringing back of the consumption and the reviving of the economy. I would say the private capital would be more incentivized to invest in things like high technology. Also, the government would try their best to stimulate this.
Yeah. And perhaps that rebound in confidence, Jiahe, could also lead to a boost in foreign direct investment as well. So when you take a look at the readout, the communication from the work conference, what do you think was the tone that was set when it comes to wider market access for next year and when it comes to further attracting foreign direct investment into China?
Well, I would say that's quite a good chance for the foreign investment to come into China, because when you look at the past 3 years, there has been rumor among some of the global investors saying that China will block its economy forever, just to wipe out every piece of the virus, and the economy will not be investable. That's been a rumor there, and that stopped some of the investors from coming in. If you look at Hong Kong market in the past 2 to 3 years, it's poor performance, and the cheap valuation brought by such performance has been a result of that. But now the hard factor has proved that China also has a very strong intention to grow its economy once the Omicron is proved to be not that harmful. We alleviated all the blockade within just probably a week, So the economy is really turning back. The confidence towards the consumption and the economy is turning back. And the FDI would be something that really inflow into the country in the coming year. Actually, if you see the capital market, where investors are really acting very quickly and actively, we have seen that in November alone, the Hong Kong market rebounded by about, I think it's either 20% or 30%. I can't remember the precise figure, but around 25% within just a month. People start to come back and pick the money.
Mr. Ding, what about you? What do you think was the tone set for wider market access, for attracting and utilizing FDI for 2023? Was there differences, nuances compared to previous sayings about FDI?
I think China is one of the biggest beneficiary of opening up, including in terms of trade, but also in terms of foreign investment. So it just does not make sense, I think, for some of the commentators to talk about China is going to close its door. Of course, now China faces another hurdle, even if China want to open up, want to attract foreign investment, I think that there are increasing restrictions from some, I think, the developed world, including Europe, including US. So it is actually even more important for China in order to avoid a decoupling, or at least to postpone the decoupling of China's economy with the US and Europe, to further promote the FDI. And also, I think, because of especially the technology restriction imposed by the US, I think such collaboration, such economic cooperation with the foreign countries become even more important. And if we look at the recent tones, I think China continue to try to keep the business relationship with the US, even with all those pressures. China continue to talk about the bilateral investment treaty with Europe and in its, I think, surrounding areas in ASEAN region. China continue to promote free trade and investment in the context of the RCEP, and also China continue to strive to join the CPTPP.
Yeah. And I think something else that China is seeking to attract is definitely talent. And talent was also something that was mentioned at the Central Economic Work Conference this year that was not mentioned in 2021. And the Work Conference said there is the need to nurture domestic talent and attract overseas talent as well. Dr. Wang, consensus forecasts still call for China to eventually become the world's largest economy. And we know that China is on the path to transforming itself into an innovation-led powerhouse. So given all of that, high caliber talent, definitely very crucial. It's highly, it's very indispensable. we know, of course, advanced economies have the ability to attract top-tier talent from all around the world. And I think you've done some research into this in terms of cross-border mobility and talent development. So give us a sense of what China has done already in order to attract international talent to come to the country, and what more do you think needs to be done?
Yes, I think that China in the past is a country that really constantly have policies supporting students study abroad, attract foreign students coming to China, and of course they have different talent plans to attract foreign talents. And for example, even during the pandemic time, that any foreigners and overseas Chinese, of course, they have PhD degrees, they can get a green card in China voluntarily, and of course, but again, the key is that for the last 3 years, China suffered hugely on loss of those talent. I mean, the expatriates population in Beijing has shrunk by half, and also probably shrunk another half in Shanghai. And so you can talk about maybe altogether used to be over 500,000 foreigners, but now maybe 250,000. A lot of school foreign teachers has also gone, and so that's really a big problem. So I think it's no really surprise that Central World Economic Conference emphasizes talent attracting again, because now we are open. But I think we still need to implement that. All the local governments still kept foreign in-flights low. I mean, government has said one of the particularly emphasizes that we have to facilitate foreign enterprise to coming back, and that's been including the talents. So I think the key is that we have to really open up. For example, if you got positive now, you can quarantine at the home. But why are all the people flying back have to be quarantined at the hotels? So doesn't really make sense. So things like that, local government has to change quickly. I noticed Macau government has changed that to quarantine at the home now. So I think those are really central government calls for measures taken to really quickly address this kind of situation. So I think in that is the case. Also, the student exchange has to resume. There's no foreign student cannot coming back. For the last year, China has almost 200,000 students went to the United States, currently study in the US. There's only about 300 US students studying in China. So that's how the contrast can be. So that's really how I think the government realized the series of this and really calling for the development of attracting the talents. So I think that's important. Not only the talents for the expatriates already in China, multinational want to send them back, but also for the new talents, for new students, and for this talent flow and talent traffic and lift quarantine, and then those are really urgently needed to address this talent deficit and talent shortage now.
Okay, totally understandable, I think. But in terms of the long-term opportunities here in the China market, Dr. Wang, I just think there's just endless opportunities for talent all over the world that can come over here and discover sort of the exciting business opportunities and development opportunities that come as China continues to grow its economy. And if we sort of step back and take a look at the overall macro backdrop for next year, Mr. Ding, we have a global economy that's slowing down right now. There are rising recession risks for several of the advanced economies, including in the Euro area, in the United States as well. So given all of that, and we expect China to see that growth rebound for next year, how much do you think China will contribute to alleviating some of the economic uncertainties that we will see in the global economy in 2023?
Most in the markets now expect a significant slowdown of the global economy, partly because of the tightening of the financial conditions as major central banks continue to hike rates, also because of the falling real wages due to high inflation, but also I think a little bit related to the geopolitical risks. So our forecast for next year, global economy would slow down to 2.5% from an estimated 3.4% this year. And for China, I think the growth may rebound from 3% to 5.8%. So arithmetically, excluding China, the global growth would be even lower than 2%. So that is, I think, already, I think, suggests, I think, the contribution of China's economy. And more importantly, if we look at the source of growth, source of recovery, in China, it's likely to be dominated by domestic demand. We actually see net export to contribute the contribution would be negligible, almost zero. And this year, net export contributed about 1 percentage point to China's GDP growth. Next year, because of the weaker external demand, but also because of falling commodity price, we may see negative export growth for China, and import growth actually could outperform export because of recovering domestic demand. So I think if China's import demand start to increase, that would benefit the rest of the world, including China's demand, for example, a commodity, people traveling more. I think the demand for crude oil, the property sector start to stabilize. That would help with the base metal, and people start to go to work normally, and that could actually increase the demand for luxury goods. And when China's borders start to open, I think the quarantine requirements start to be less restrictive. We may see more international travel, and the rest of the world may again see a lot of Chinese tourists.
Yeah, I think some definitely positive spillovers, especially for the regional economy. Final question, Jiahe, I want to pose to you. I just want to step back again and take a look at the long term and come back to this question of consumption in terms of what do you think is the long-term potential of domestic consumption here in China in terms of how much more is there left to be unleashed? We've got about 400 million people now in the middle income group. The goal is to get to 800 million people in the middle income group in 15 years' time. So it just seems like the sky's the limit for consumption here in China, and especially as people's income and prosperity continues to rise with such a large base of middle income consumers.
Yeah, I think you mentioned the very large base that the Chinese consumers are. I mean, you talk about the middle class consumers, and it's a huge population. You know, it's a huge amount of people here, and a huge amount of pets. When you look at, you know, people consume a lot of things when you have over like 1.4 billion population becoming richer and richer. Also, another important thing is that Chinese economy has got a large potential to grow. Currently, our per capita GDP back in 2021 was $13,000 per capita. And when you look at the per capita GDP of developed economies around the world, that's around 40 to 50,000. So we have a long way to go. Another thing is that Chinese economy in the past has been really focused on things like investment and export. We didn't have a strong consumption economy compared with our large scale. So it's really a huge place to go. When we talk about a large consumer base, we talk about a rising income, we talk about a more proportion of consumption in our economy. So it's really a lot of things to go. You look at many sectors, consumption of food, of recreation stuff, of pets, of cinemas, of computers, or things like this. So Chinese consumption market is really somewhere that global investors and businessmen cannot miss.
Yeah, maybe, Michael, I'd like to add one point to that. I think in the last 3 decades, you see 4 decades, actually, every decade there's a policy that really drives up. In the 1980s, we have the contracting system for the rural area that really lifted, from the shortage of the goods to the abundance of the supply. And in the 90s, we have the housing reform, where made China huge growth in the urbanization. And in the 20th decade, and then we had a joint WTO, and China GDP has gone up 10 times. I think there's one big, dividend low-hand trade there that China should tap into. And I see, World Economic Conference could be more emphasis on that. Is the rural, the contracting of the household land, because 600 million farmers occupy this household land, but not be able to transact, not being able to transfer. And if that is actually be tapped into, urban people can go to the countryside, and countryside people can come to the urban center. That'd be huge, a fourth revolution of new decades. So I think that is a big, potential that has been unleashed. I think hopefully with the new Central Committee government leadership, that will be the next, big, dividend for the reform and harvest for the new decade.
Oh, I completely agree with you, Dr. Wang. I think policymakers definitely have a focus on that. Rural revitalization is what we call it here. We still have hundreds of millions of people, right, living in China's vast countryside. So to bring them up to the middle class would be absolutely huge when it comes to development dividend, when it comes to the consumption dividend. And of course, China's policymakers are trying to shrink the rural-urban development gap. We're going to see more coordinated development between urban and rural areas as well. So I think the potential is starting to get unleashed in the rural areas. That is definitely an exciting front to be looking out for. So thank you for bringing up that point. And rural revitalization, of course, was also talked about in the Central Economic Work Conference as well. But perhaps we can leave that for a discussion for another day because we are out of time. So I want to thank all of our panelists for joining us today. We touched upon sort of the short-term signals that were sent from the Economic Work Conference. I think we can all agree ensuring economic stability, that is going to be the overall tone for China's economy next year, but there's definitely a more pro-growth bias in terms of boosting consumption to really spur the recovery that we will see in China next year. And I think that will definitely contribute to alleviating some of the economic uncertainties that we will see in a global economy that will be slowing down in 2023. All right, so I want to thank all our guests for joining us today in our edition of BizTalk, where we try to decipher some of the signals from the Central Economic Work Conference. So Dr. Wang, Jiahe, and Mr. Ding, thank you so much for your time today.